Go. Oh, wow.
Okay, I had four.
You guys gotta remind me to do that.
I had 4.6.
I always get so carried away. I forget. No, you're gonna be the first one in the video.
Okay. I had 4.6, and it said the equity multiplier of Spiffy Corporation is 1.75. Its EBT, return on assets, is 0.07, and the value of its equity is $850,000. What is the value of Spiffy's total assets, and what is the value of its EBIT? So, for this, we use these two equations, the equity multiplier and the EROA. And then that's, the equity multiplier is total assets over total equity, and EROA is the EBT over the total assets. So to find the equity multiplier is given, so it's 1.75, and then EBIT over 850,000, and then you multiply that out and you get total assets equal 1.75 times 850,000, and then that is 1,487,500, and then you plug that into the EROA equation, and the point it's supposed to be 0.007, but 0.007 equals EBIT over 1,487,500, and then you multiply that out and you get 104,125.
Thank you.
So I had problems 4.15 and 4.16. So for problem 415, Lambda Corporation has current liabilities of $450,000, a quick ratio of 1.8, inventory turnover of 5.0, and a current ratio of 3.5. What is the cost of goods sold for Lambda Corporation? So first, you have to find the current assets, and you do this by taking the current ratio and multiplying it by the current liabilities. You get $1,575,000. And then you have to find the quick ratio to get the inventory, so you kind of work backwards and you take the current assets minus the inventory divided by current liabilities, and you multiply this number by this number, and then you divide by that number, and you get it, and then inventory equals $765,000, and then you have to do cost of goods sold, and you get 5.0 times 765,000, and you get $3,825,000. And then for 4.16, you take it's Norwood Corp currently has accounts receivable of $1,223,675 on net sales of $6,216,900. What are its accounts receivable turnover and days sales outstanding? So you have to find the DSO. The first thing you do is do accounts receivable turnover ratio, which is net sales over accounts receivable, and you get 5.08 times. And then you have to find a DSO, you do 365 days, because that's the amount of days in a year, and you divide that by accounts receivable turnover, which you got here, and then you get 71.8 days.
Based on the financial statements for Tom Covic Golf Company, compute the cash flow invested in net working capital and the cash flow invested in long-term assets that you would use in a calculation of the cash flow to investors for 2017. So for the cash flow invested in net working capital, you plug it into the equation. You subtract current assets from previously accepted liabilities, and then current liabilities from current assets. And then you would take your previous net working capital and subtract that by the recent net working capital, and that would end up in negative $6,467. That's your net working capital. And then for cash flow invested in long-term assets, you also plug that into the equation. So you subtract 1,931,719 by 1,609,898, and then add that with the $301,000, which is your cash flow invested in your long-term assets, and those are your two separate equations.
Alright, 3.6. The question is, Sun Devil Corporation reported earnings before interest, tax, depreciation, and amortization of $7,300,125 and a net income of $3,328,950 for the fiscal year ended December 31st, 2017. During the same period, the company had $1,155,378 in interest expense, $1,023,285 in depreciation and amortization expense, an average corporate tax rate of 35%. What was the cash flow to investors from operating activity during 2017? So you start with the equation of cash flows from operating activity minus earnings before interest and tax minus current taxes plus non-cash expenses, which then turns into earnings before interest, tax, depreciation, and amortization minus current taxes. And then you plug in the numbers, so $7,300,125 minus 0.35, which is the 35% tax rate, $7,300,125 minus $1,023,285 minus $1,155,378, and then you get your total of $5,507,613.
Alright, so I have problem 3.3. Question was, a casino company earned $23,458,933 before interest and taxes for the fiscal year ending March 31st, 2017. If the casino had interest expenses of $1.6 million, calculate its tax obligation. What are the marginal and average tax rates for the company? So first, your EBIT, which means earnings before interest and taxes, that's going to be your $23.4 million. And then your interest is the $1.6 million, and then your EBT, the earnings before tax, is going to be your $21.8 million. And then right here on the side, you get the tax rates that range from 15% to 39% based on your income. So in order to get the tax number, you have the first tax bracket, which is 0 to 50,000. You take 50,000, multiply it by 0.15 to get your 7,500. And then, for example, for this 25% tax bracket from 50,000 to 75, you're already going to get taxed 15% up to this 50,000. So the next 25,000 from 50 to 75, you're going to get taxed 25%. So you go 25,000 times 0.25 to get your 6,250, and then you do that all the way down, and then you get your final tax number after adding all these up, which is $7.6 million. And then since the $21.8 million for the EBT is more than your $18.3 million in this bracket, your marginal tax rate is going to be 35%. And then at that point, you do the total taxes payable divided by the taxable income, which is going to be the $7 million divided by the 28, which ends up giving you the 35% as well.
That's your effective tax rate, too.
Yes.
That was really good.
Thank you.
So I had 313 and 314. I'm just going to start with 313 first. The Hillman Corporation reported current assets of $3,495,055 for the year ending December 31st, 2017, and current assets of $3,103,839 on December 31st, 2016. Current liabilities for the firm were $2,867,225 and $2,760,124 at the end of 2017 and 2016, respectively. Compute the cash flow invested in net working capital at Hillman Corporation during 2017. So what you got to do is you got to do the 2017 assets subtracted by the 2017 liabilities, then subtract that by the 2016 assets minus the 2016 liabilities. That comes out to $284,115. Then for 3.14, the Delta Ridge Construction had long-term assets before depreciation of $990,560 on December 31st, 2016. and $1,211,105 on December 31st, 2017. How much cash flow was invested in long-term assets for Delbridge during 2017? So all you gotta do is the 2017 long-term assets before depreciation subtracted by the 2016 long-term assets before depreciation, you get 220,545.
Alright, so I have 310. The question reads, cost of chemicals management identified the following cash flows as significant in its year-end meeting with analysts. During the year, Caustic had repaid existing debt of $312,080 and raised additional debt capital of $650,000. It also repurchased stock in the open market for a total of $45,250. What is the net cash provided by financing activities? So you do, you subtract the loan repayment, which is $312,080. You add the increase in long-term debt of $650,000, and you subtract the purchase of treasury stock, which is $45,250, and that gets you a net cash provided by financing activities of $292,670.
Okay, I did 2.28. Sorry, it's like kind of small. The question says, imagine you borrow $500 from your roommate, agreeing to pay her back $500 plus 7% nominal interest in 1 year. So inflation over the life of the contract is expected to be 4.25%. What is the total dollar amount you will have to pay her back in a year? What percentage of interest payment is a result of real rate of interest? So for that first part, how much you're going to pay her back, you just take the $500 that you borrowed, you add that plus $500 times 7%. So 7% of 500 is $35. You add that to the original 500 that you have to pay back, it ends up being $535. To find the real rate of interest, you already have the inflation rate as well as the interest rate, and using the Fisher formula, you kind of just plug in the numbers. Ends up being the real rate of interest is 1.07 divided by 1.0425 minus 1. The real rate of interest will be 0.02638 or 2.638%. You plug that in again to find out the amount that came from the real interest rate. So you multiply that 0.02638 by 500, ends up being $13.19. And then you just divide that by the $35 originally in interest, and you get 37.6%.
So I did 1.7. I'm going to read the question. Norton Company has a debt to equity ratio of 1.65, ROA of 11.3%, and total equity of $1,322,796. What are the company's equity multiplier, debt ratio, and ROE? So the first one is the equity multiplier, which is kind of like a simple equation. So you just do 1 plus the debt to equity ratio, which is 1 plus 1.65 is equals to 2.65. So that's the answer to the equity multiplier. Next is the ROE equation. So to get that, there's a couple different things you have to do before it. So for ROE, first you're going to find the total assets, which is the equity multiplier times total equity, which is 2.65 times 1,322,100. 1,320,796, which will be 3,505,409. And then next you have to find the net income, which is the ROA plus total assets. Since ROA is given, that would be ROA is 11.3. So from that you have to do 11.3 times 300. 3,505,409, which gives you 396,111. And then finally, to get to the ROE, you're going to do net income over equity, which is going to be 396,111 over 1,320,796. And then it will give you the 29.9%. And then the last one's the debt ratio. ratio, which is, the equation is also pretty simple, so it's gonna be 1 minus 1 over the equity multiplier, which is this little equation right here. So it's gonna be 1 minus 1 over 6.2, which will give you 0.623. And then I also did 4.6 over here. So for that one, the question asks, Breckenridge Ski Company has a total asset of $422,811 and a debt ratio of 29.5%. Calculate the company's debt to ratio, equity, and equity multipliers. So the first one to get to it, you have to first do find the total debt, which are given, the numbers are given for it. So it's going to be $4,022,811 times 0.295. So the first number was the total asset, and then the second one was the debt ratio, and that will give you 1,124,559,564. And the next is the total equity, which is the equation to get that is total asset minus total debt. So the numbers would be 422,235,811. Subtract that by 124,559,564, which will give you 297,676,247. And then finally, to be able to get to the debt ratio, you would subtract, or you would divide the two numbers that you had received. So this number right here and then this number right here, you would divide them, shown right here, and that will give you 0.42. And then the last equation is for the equity multiplier, which is total asset over total equity, which is down here. So that would be 422,235,811, and then you divide that by 2,297,676,224. That'll give you 1.42, and that's the answer for the equity multiplier.
All right. I did 4.3, and as you can see, it's mostly basic algebra and terminology. So, the problem says, if Newton manufactures an accounts receivable turnover of 4.8 times and net sales of $7,812,379, what should its receivables be? So I just listed all of that in the problem here. Then I took the definition of accounts receivable turnover, and it turns out net sales over accounts receivable equals accounts receivable turnover. And then I plugged in the values, got that. Then I did basic algebra, and I eventually got the result of 1,627,578.96, or if you want to round it, 1,627,579.
And the question says, you lent $100 to a friend for 1 year at a nominal rate of interest of 3%. Inflation during that year was 2%. Did you experience an increase or decrease in the purchasing power of your money? How much did it increase or decrease? So since the interest rate you received, which was the 3%, exceeded the rate of inflation, then you got an increase in your purchasing power. And so to calculate how much it increased, with this equation, so 1 plus interest rate is equal to 1 plus the real rate times 1 plus the inflation rate, or the change in price. So R is equal to, and then you just plug in all the values, and so our purchasing power increased by 0.98%.
1.12, we were going over market value ratios, and problem states Rockwell Jewelers Management announced that the company had net earnings of $6,481,778 for this year. The company has 2,543,800 shares outstanding, and the year-end stock price is $54.21. And the question asks, what are Rockwell's earnings per share and price per earnings ratio? And from the problem, we're given the net earnings, which is $6,481,778, the shares outstanding of 2,543,800, and a year-end stock price of $54.21. The formula for the earnings per share is net earnings over shares outstanding, which is given here. So I just plug that in, and I got 2.55, and from this we plug it into the earnings price per share down here. And the formula is price over earnings per share, so it's $54.21 over the 2.5, and that gives me 21.26.
So I had 3.28, and it says the Centennial Chemical Corporation announced that for the period ending March 31st, 2017, it had earned income after taxes of $2,768,028.25 on revenues of $13,144,680. The company's cost excluding depreciation and amortization amounted to 61% of sales, and it had interest expenses of $392,168. What is the firm's depreciation and amortization expense if its average tax rate is 35%? So here you kind of had to work backwards. So I gave you the net income, and I divided it by 66% to get the earnings before taxes, and then I multiplied that to get about 34% to get taxes. So then you work back up, and then you subtract interest, which gives you the earnings before interest and taxes. And then you would subtract the cost from revenues minus cost, and then you get the depreciation and amortization.
For 4.14, we're doing liquidity ratios. The problem goes, L'Oreal Electronics has a quick ratio of 1.15, current liabilities of $5,311,020, and an inventories account of $7,121,599. And it asks, what is the firm's current ratio? From the problem, we're given a quick ratio of 1.15, a current liabilities of $5,311,020, and an inventory account of $7,121,599. The formula for quick ratio is, we end up solving for current assets, but the formula for the quick ratio is current assets minus inventory divided by current liabilities. And from all the information given, we just plug it in and we solve for current assets. We do the algebra. Current assets ends up being $13,229,272, and we plug that into the current ratio formula, which is current assets over current liabilities, and we end up getting 2.49.
and action.
Alright, so we did chapter 1, the financial manager and the firm. Some of the learning objectives for this chapter, identify the key financial decisions made by financial managers, common forms of business with disadvantages and advantages of each one, describe a typical organization of the financial function in a corporation, and then we'll also explain why maximizing the value of the firm's stock is a goal for the management team. We will also discuss how agency conflicts affect the goal of maximizing stockholder value, as well as explaining why ethics is important in corporate finance. So the role of financial manager is maximizing the shareholders' wealth. As the stock price increases, the value of the firm will also increase, as well as the wealth of the shareholders and owners. To give a little refresher with what the difference between stakeholders and what shareholders are. Stakeholders are interested in the performance of the company, whereas shareholders actually own part of the company. Example of some stakeholders may be managers, employees, suppliers, creditors, or the government. Cash flow. So here's like a cash flow chart. Cash flow is created by goods and services into the firm, and that can be paid to suppliers, stockholders, and with positive cash flow comes like dividends, or it's invested back into the firm, as you can see with like the residual cash flow. It's either reinvested or paid as dividends to stockholders. More cash flow means more value for the firm, whereas negative cash flow means the company's going to close or go bankrupt. So 3 fundamental decisions for financial management. The first one being capital budgeting, which is identifying the long-term assets to maximize net benefits for the firm. The second one is financing, which is determining how to pay for short-term and long-term assets and finding the nice balance of short-term and long-term debt. The last one is working capital, which is to manage short-term resources by adjusting the current assets and liabilities to promote more cash flow. And then poor decisions made by financial management could lead to things like closure and bankruptcy. So now I'm going to get into forms of business organizations. The first one is sole proprietorship. It's owned by a single person who is financially responsible for the actions of the business. Some advantages of it are it's easy to create and dissolve, and as a sole proprietorship, you have the right to all profits. Some disadvantages are owners' personal assets are at risk due to unlimited liability for firms' obligations, and it's also difficult to transfer the ownership. Partnership is the second one I'm going to be talking about, which is a business that's owned by more than one person, and one or more person is responsible for the actions of the company. Some advantages to a partnership. There's more sources of equity in enterprise. Another advantage is limited protection of owners' personal assets. Owners' limited liability for firms' obligations. Some disadvantage that comes with partnerships are shared control of profit, and they're all harder to dissolve. And then the last one I'm talking about is corporations. It's a business owned by more than one person, which none of them are financially responsible for the actions or obligations of the business. Some advantages are it protects personal assets, it's easier to change ownership, and it has greater access to funds than all of the two before. Some disadvantages of a corporation, they're difficult and expensive to establish, and also overall higher taxes on income for shareholders.
So now we're going to be talking about hybrid forms of business organization, and the two names are kind of self-explanatory when they talk about limited liability, meaning that these two in particular protect one's own personal assets, as opposed to unlimited liability, which is provided by sole proprietorship. So now you can distinguish between the partnerships and companies. So with the limited liability partnership, it's a partnership that consists of at least 2 persons. and liability of a single partner is dependent on their own contribution in capital. For a limited liability company, it can be one single owner and combines the asset protection of a corporation with the simplicity of a partnership. And it consists of several members, and personal assets are protected from, let's say, company debts, or if someone were to sue the company, they themselves aren't in danger. And there's also a process that is called a through process taxes, which is done where a member reports their profit and losses from the company and their own taxes, and by doing so, they actually end up, as a whole, the company gets a better tax rate. Cool, so the next one. And this is kind of a visual representation of the differences between a sole proprietorship, a partnership with a general, limited, or corporation, and limited liability. And as what we talked about here, with the liability of owners, you can see sole proprietorship unlimited, and as you go down to the end, the limited liability is limited. So then we go to managing the financial function, which is basically kind of like describing the hierarchy of financial management. At the top is the CFO, who reports directly to the CEO, and they work kind of together in terms of creating strategies. The CFO also implements systems to gain efficiency, negotiates with clients, vendors, and investors, controls budgeting, and also presents financial reports in order to influence decisions in the company. Those who work directly under the chief financial officer are the treasurer, risk manager, controller, and internal auditor. The treasurer controls cash payments or collections, foreign exchange, pension funds, derivatives hedging, which is kind of like derivatives hedging. I would assume hedging being that it's kind of like a risk analysis in a way. The risk manager monitors risk in the financial and commodities market, creates strategies to limit risk, and the controller operates to run financial accounting, taxes, financial systems, and accounting information systems. The internal auditor audits high-risk areas, prepares paperwork for external auditors, works for cost savings, and internal fraud detection. And then the last three are controlled by the board of directors, which is the audit committee, which oversees financial reporting and disclosure, and brought from the outside, which means they are independent directors. Then there's an external auditor, which the board hires a public accountant that audits and reviews the company, which is an impartial evaluation of financial statements, which is key that it is impartial when providing that information to potential investors. And then the compliance and ethics director, basically his job is just to suspend and identify any illegal practices in the workplace. We can go to the next one. And then this is kind of a visual representation of the hierarchy. And as you can see on the top is the board-controlled audit committee, external auditor, and compliance and ethics director, and all of these who report directly to the CFO. We can go to the next. And then the goal of the firm, why would it not be to maximize market share? One of the examples given was that you could provide free goods and services to all, but yet that practice isn't really sustainable, and probably a business that does that wouldn't stay in business for very long. And why also not focus on maximizing profits? Because accounting profits is different from the actual profits or cash that you're receiving, meaning that you still have accounts receivable and things like that. So it's really not optimal. So the optimal thing is to maximize value of stock. And by doing so, there we go. And it's the best route because it takes three things into account. It takes the future cash flows into account, the timing of future cash flows, and the wait time for cash flows. And so the success of the firm is largely dependent on the management making decisions in terms of stocks, and that will determine what the stock prices of the firm are. So you can go ahead and press it.
Hold on. What was after timing of future cash flows?
Timing of future cash. It was only three. It was timing of future cash flows, and then the last one is wait time for cash flows.
Thank you.
And then these are the major factors that affect stock prices. It shows both internal and external. As you can see, the external things that would affect could be wars, natural disasters, a recession, antitrust laws, taxes, procedural and safety regulations. But what can be done, like I said, internally is decisions made in management, line of business, product quality and costs, marketing and sales, research and development, and all these in conjunction lead to the stock price. And then we move on to a different topic, which is agency relationship. An agency relationship is basically, from what I took from it, is the relationship between the stakeholders and the management and the owners of the firm, basically handing over all the assets and control to managers, and how that can potentially lead to conflict in terms of management always having to please the stakeholders. And I think getting more into that.
Right, and then reiterating what he said, for an agency relationship, it exists between the stakeholders and the firm's management. So some conflicts that we see with that is that in large corporations, when there's many stakeholders in the company, they kind of lose focus on watching, or like they have little control over management. And although stakeholders own the corporation, managers control the firm's assets so they can actually use them for their own benefit. And then agency costs are costs that arise from incurring and preventing conflicts of interest between a firm's owners and managers. So what costs can do is they can reduce positive residual cash flow, stock prices, and shareholder wealth. Some ways that they can be reduced is increased oversight and aligning incentives. So if stakeholders are watching over the managers more, and controlling them a little bit more, then they would have a better alignment there. And then giving agents the right incentives to reduce agency costs, managers can focus on maximizing wealth as their compensation depending on their stock price. And then aligning the interests of managers and stakeholders. So board of directors actually have oversight over the CEO and major capital decisions within a company. Managerial labor market provides incentives as well so that the company does run well. And then internal competition among managers. Large stakeholders also monitor managerial decisions. The stakeholders are owners of the company. And then corporate raters search for takeover targets. Legal and regulatory constraints limit managerial behavior too. So they did incorporate SOX in 2002. Basically, I believe it happened after the Enron scandal or around then. Basically what SOX does is it's an audit that helps catch fraud within a corporation. So here's a little bit more about SOX and more regulatory reform. So it's just more effective on monitoring managers and their activities. It promotes appropriate behavior by managers, and then penalties for executives who do not fill their responsibilities within the corporation. So the new regulations require all public corporations to implement the following strategies. So any public corporation that's gonna give a SOC 1 report to their consumers, or even a SOC 2, they have to get a SOX audit done. It ensures greater board independence, establish internal accounting controls, establish compliance and ethics programs, and expand the audit committee oversight power. So basically what they do is they'll test a whole bunch of controls within the company to see if they're compliant with them. So basically this is just an exhibit in the textbook 1.6. It's corporate governance regulations designed to reduce agency costs. So it goes over board of directors, what they do, the audit committee, and the external auditor, but he also touched on those three too. So, and then importance of ethics in business. So ethics are really important. It is a society standard for judging whether an action is right or wrong. Business ethics are society standards for acceptable behavior applied to the business and also financial markets. So ethics in corporate finance. A couple examples of ethical conflict in business is agency cost, so employees' unacceptable use of an employer's computer. Conflict of interest, so say you have a mortgage contract where a home buyer is unlikely to fulfill, but it earns the mortgage broker more money. Information asymmetry, so the seller knows about prior damage to a vehicle, but they don't tell a new buyer about it. Business behavior, regulation, and market forces are not enough to maintain integrity in the marketplace. Business norms must be based on ethical beliefs, customs, and practices. And then ethical behavior, so sometimes it is difficult to judge what behavior is ethical or not. And then consequences of unethical behavior, so inefficiency in the economy and cost to society. And then the U.S. Recent financial crisis is a good example of that.
framework for analysis of ethical concepts too, so it's just steps towards recognizing ethical behavior.
So you guys ready?
Yeah, just trying to real quick.
Do you have three in your group? Yeah. Okay. We'll do action. Let me know if you need any help. Are you on the HDMI?
Trying to airplay.
How are you? It's down below. Yeah, there you go. Right there. No, right there. Okay, quiet on the set. And action.
So chapter 2 is the fundamentals of corporate finance, the financial system and the level of interest rates.
So 2.1 is the financial system. So there's two parts to 2.1. The first part is the financial system at work. We're talking about financial markets and institutions. Financial markets include markets for trading financial assets such as stocks and bonds rather than real assets. And the financial system is competitive, for the financial system at work. The financial system is competitive. Money is borrowed in small amounts and loaned in large amounts. The system directs money to the best investment opportunities in the economy, and lenders earn profits from the spread between lending and borrowing rates.
And then, so the funds flow through the financial system. It's a lender, savers, and then borrowers, spenders. And then the basic mechanisms by which the funds are transferred in the financial system, it's directly through the financial markets and then indirectly through financial institutions. So then this is just a diagram of the direct financing.
So direct financing, we have the direct transfer of funds, lender-saver contracts with a borrower-spender, and then minimum transaction is $1 million. Some of the things we see like investment banks and money center banks help with origination, underwriting, and distribution of new debt and equity. On the screen you see the definitions for three of those. So origination is the process of preparing a security issues for sale. Underwriting is a service to assist firms in selling their debt or equity securities in a direct financing market. And lastly, distribution is the process of marketing and reselling the securities to investors.
So there are different types of financial markets. So we have primary and secondary markets, exchanges, and over-the-counter markets, and money and capital markets.
So by primary markets, we mean wholesale markets where firms, new securities are issued and sold for the first time, whereas secondary markets, retail market, where previously issued securities are resold.
So then marketability and liquidity. Marketability is the ease with which a seller or buyer for an asset can be found, and liquidity is the ease with which an asset can be converted into cash without loss of value. And the financial markets increase marketability and liquidity of securities, and the financial markets lower the costs of making transactions and make participants more willing and able to pay higher prices.
So next is like the difference between brokers and dealers. The main difference is that brokers do not take on risk, where dealers do take on the risk. So a broker brings a seller and a buyer together, but does not buy or sell, whereas a dealer participates in trades as a buyer or seller using his or her own inventory of securities.
So then money and capital markets. So the money market is the market for low risk securities with maturity of less than 1 year. And then the capital market is maturities longer than 1 year.
This talks about like the difference between public and private markets. So public markets are organized financial markets where the general public buys and sells securities through their stockbrokers, where private markets involve direct transactions between two parties, often called private placements. Some of the advantages are it's faster and lower transaction costs, whereas some of the disadvantages are privately placed securities cannot legally be sold in the public markets because of the lack of SEC registration, and dollar amounts that can be raised tend to be smaller.
And then next is the futures and options market. Derivative securities derive their value from some underlying asset. So future contracts are the contracts for the future delivery of assets such as securities, foreign currencies, interest cash flows, or commodities. And then options contracts call for the option writer to buy or sell asset if called upon to do so by the option buyer. And then the efficient market hypothesis. So an efficient market is one in which current prices of securities incorporate the knowledge and expectations of all participants. So security prices are correct, securities are not overvalued or undervalued. And the participants are confident that they pay or receive intrinsic or fair value of a security.
So the efficient market hypothesis states that there's three types of marketing efficiency. So there's strong form efficiency, semi-strong form efficiency, and then weak form efficiency. So in strong form efficiency, it states that the price of a security in the market reflects all info, public as well as private, whereas semi-strong strong form market efficiency implies that only public info that is available to all investors is reflected in a securities market price. So an example would be public stocks developed in countries like the U.S. Weak form is all info contained in past prices of a security is reflected in the current prices.
So then with market efficiency, public markets such as the NYSE are more efficient than private markets due to the information provided by a large number of participants and effective regulation.
So for indirect financing, institutions such as banks and insurance companies are both borrowers and savers. So an institution borrows money from a saver, lends money to a borrower, and must repay the funds to the saver, whether or not is repaid by the borrower. Kind of going back to like the risk we talked about earlier. The process of converting financial securities with one set of characteristics into securities with another set of characteristics is called financial intermediation.
And then financial institutions and their services. So financial institutions, they provide lending and borrowing opportunities at the retail level for small customers and wholesale level for large customers. Efficiently collect funds in small amounts and lend them in larger amounts.
So the different types of financial institutions are commercial banks, life and casualty insurance companies, pension funds, investment funds, and business finance companies.
And then I believe we saw this one also in the last presentation, but it's the cash flows between the firm and the financial system.
So here are the four determinants of the interest rate levels: the real rate of interest, loan contracts and inflation, the Fisher equation and inflation, cyclical and long-term trends in interest rates.
So then the interest rate is the fee for borrowing money expressed as a percentage of a loan. And then the nominal rate of interest is the interest rate we observe in the marketplace. And then the real rate of interest is the interest rate that would exist in the absence of inflation or deflation.
This one's a diagram of the equilibrium of the interest rate, which is like right in the middle, where the two points intersect, or the two lines intersect. we got 2 problems from the homework. So, or no, those aren't. No, that's right. This is for the homework though.
So this is the Fisher equation, which we saw on the board a couple of times today. So we can use it to find the interest rate or rearrange it to find the real rate or change in inflation.
And this is the simplified Fisher equation example.
So the cyclical and long-term interest rate levels, the interest rate tends to rise and fall with the changes in the rate of inflation, and these rates tend to rise when the growth rate of the economy increases and tend to fall when the growth rate of the economy slows.
There's a diagram of what you're just talking about.
And
So here are the homework problems.
yeah, we included 2 homework problems that will be due soon. So this is 2.24, and the question is the first bullet point, and then the solution is as follows. What are 2 risk hedging instruments discussed in the chapter? The 2 risk hedging instruments discussed are futures and options contracts. And then this is STP, so it's 2.4, and it's list 3 forms of efficient market hypothesis and describe what information is assumed to be reflected in security prices under each of these hypotheses. So the first one is a strong form efficiency. All information is reflected in the security prices. Semi-strong form efficiency, which is all public information is reflected in the security prices. And then weak form efficiency, where all information is contained in past prices is reflected in the security prices.
Thank you. So for the thank you, that was great. And the presentations were great too. So I'm going to spend the last 10 minutes. What's today? What's the date today? What happened today?
9/11.
Let me tell you my 9/11 story. So I was living in San Francisco. I woke up in the morning and I was living in my apartment, and I had a TV, and I looked up and I saw the Twin Towers go down. And I went, holy shit. And I went to my office, and I had just completed a quarterly report where I forecast the real estate markets across all 14 of our markets. So I had the quarterly report, I had it all done, I finished it the day before. It was all bounded up, it was beautiful. I had it all, I had the memo on top, the CDs were burned. I had them all, basically printed out in color, so it was really expensive. And then I was getting ready to put them in the envelopes and mail them out to the board of directors and then give them out to the senior level executives. But I knew that 9/11 was such a significant event that I decided that I would throw the reports away because they were basically meaningless and worthless at that point, because I knew that the Twin Tower collapse was going to have a major impact on the capital markets and on the economy. It would probably send the economy into a recession. If prior crises similar to that kind of crises occurred, since I was a student of economic cycles and recessions. So the senior level executives came into my office and they said, you haven't sent out the report yet. When are you going to send it out? It's late. And I said, oh, I've had some problems. Just totally, lied. And I said, I had some problems and I needed to go back and collect the data, so I had to redo the reports, and I was about a week and a half late, and they just kept coming into because the board meeting was coming closer and closer, and I didn't want to tell them, that I was going to do a recession scenario and republish the forecasts and send them out to the board of directors under a recession scenario, not under a growth peak phase business cycle scenario, because I knew that they would talk me out of it. So I just did it anyway. Mailed it out to the board of directors and the senior level managers. The CFO came into my office after he read my report and he said, you should be fired for producing that report. And I just, I didn't really say anything, and he kind of stormed out of the office. And the CEO was pretty upset with me too in publishing the report, particularly mailing the report to the board of directors. But I felt I had a moral and ethical obligation to do it. And I knew that they would manipulate me and talk me out of it and try to compromise my forecasts if I had told them I was going to do it. So it went out to the board of directors. The senior level management came back to me. They said, you're gonna have to redo your forecasts, and we are gonna help you with your forecasts. Okay, so I basically had to go back and manipulate my forecasts to meet what they wanted to see in the forecasts. I had to basically reproduce the report for a third time, and then had to mail it out, back out to the board of directors and the senior level executives. Within 1 year after that, my original forecasts came true. We fell into a recession, and they had to lay off like 20% of the company. They weren't happy with me about a lot of this stuff, but I got to keep my job for at least that year. And then a new set of senior level executives came into the firm in the second year, and I had worked with her before, and she said, before that, in the second year, they had laid me off, and then they hired me back afterwards, okay, as a consultant. And then before I left the firm in the end of the second year, the new president of the company called me into her office, and she said, hey, I want you to take a look at these numbers, because before you leave, I want you to do a presentation to the board of directors. So what I did was I went ahead and put your original forecasts across the 14 markets and overlaid them based on the actual numbers, of collected rents and net operating income, and then overlaid that on the forecasts that the management told you to go back and manipulate. So she put together the presentation to me. I did some research, and then made the final presentation to the board of directors before I left the firm. And my forecasts overlaid on the actuals was like 90% correct. I was like, totally nailed it in my projections of what the impact on the net operating income would be by market and on the total portfolio in the firm over a 3-year period. So that's just something to think about. That's my 9/11 story, but I'll stick with it because I was able to maintain my ethics. I was able to then go on and work for Schwab and develop the property derivative indexes and help launch the property derivatives market, and all of that work got rolled up into my dissertation to get the doctorate, and that's why I'm here. Okay? So it all worked out. Okay? So that's my 9/11 story. All right? So thank you. Yeah, the CFA challenge. Yeah.
Send an email what docs and slides?
It's on Moodle. You have to edit it.
Oh, okay. Then I'll look at what
Well, see, you got, I think I'm not sure about that. Because he is. I know what's happening. Yeah. I said, yeah, I take it back.
Like 12 minutes.
Got it.
Does that help?
Yeah.
Thank you, nice job. Yeah, we usually around this between 7 and 11.
Yeah, for the next one. Yeah.
We
We didn't know either if you were like still in the class because of the, it was like a month, you know what I mean? It was like the second day, yeah, so we were like, oh, he might have. Yeah.
Friday in the afternoon. So if you want to eat after my class,
So I texted her.
Well, then I'll get around to meeting.
And then,
Let's say, Thursday, Friday.
and then.
And then, I'll work on the slides. You can send them to us.
Maybe have to
Yeah.
Slide and everyone put on it.
CFA.
Yeah. Read the doc.
Yeah, I can do it, and then I'll.
University.
Oh,
Get like,
Take care of it. Everyone pick what they want.
We should definitely look over the slides, have practice day, and make sure our format matches.
Oh, yeah. So we'll just do it on the
We've done the pre-test and then I'll start doing the testing Monday.
Got it.
Go through it. Yeah, I'll start reviewing
Yeah.
this.
Hiring.
So we should have it done by Monday then.
What the pre-test?
Yeah.
Yeah, I have the
to
pre-test.
do this.
The pre-test.
Okay.
Yeah, and if you have any questions or something, just leave them blank and I can go.
Okay. Okay, quick questions, like the homework problems, are
Yeah.
those also due?
No, I did not.
I don't know, look at the syllabus. We've already been assigned. And usually what I do is I just look at them
Okay.
and then just make sure everybody's on track and filling them in if there's any gaps. If we still need more time, I just, continue to keep pushing them forward and have to work on it. So I just check it to make, it's really more to check
Okay,
to see who's not doing it.
right. So when we turn it in, do you just want, like you did now, like just a solution? Or do you want us to
For
copy
the
down
homework,
homework?
yeah, just the solutions.
Okay, on like
And
just
just-
the binder paper?
Yeah,
Is that
and
okay?
a cover page.
Okay, so I'll just do it on the paper.
Yeah, and then show it to me and then I'll show you how to do the cover page.
Okay, thank you.
Cool. What, you don't have a question for me?
Actually, yes. Can I do it on binder paper and then put a cover
Do you
page?
do you have a question?
Well, I was just gonna ask about the due date thing, because, just the test is due Monday, right?
The pre-test?
Yeah.
Yeah, I want to look at it,
Okay,
just to make sure everybody's on, up to speed.
thank you.
Is there a provider on that?
Yep, and Steve will do
Yep.
that. No tikka masala, no kitty paws.
Oh my gosh, stop.
And then which group have you had up?
Let me take a piece
What's
of
the group
this.
you had up?
I love these white chocolate chips. Yeah.
Aren't you like the leader of a group?
That again,
Lead again, Cindy?
the VP.
Do you want to be a co-sponsor in our event?
Which of the items?
That one.
But what is it?
So, to be a co-sponsor, you have to basically drive down traffic. And then, spend 2 minutes up in front of everybody telling us about it.
Wait, what are you doing?
Red again, the sigma.
That's for academics, right?
It's like the
Like an honor society.
honor society.
Yeah, so talk to your leadership. We'll put your,
That's the first time I was meeting with our team.
we'll put your logo right there. And we'll say co-sponsors. And we'll have accounting, econ, marketing, and then you guys do 2 minutes on your clubs in front of 300 people.
And I'm gonna meet with Mary Beth this week to talk
Perfect.
about red again, the sigma.
Perfect. Awesome.
I'm gonna help put in the team, the internship benefits.
Great.
And
Fantastic.
then the sigma.
Cool.
That's awesome.
Good. Congratulations.
Yeah.
Okay.
Thank you.
You're welcome. How are you today?